Amazon shares dipping after the company announced their Q1 earnings. Should you step in and buy the dip on Amazon? We'll look at it technically, but as always, we'll look at this one fundamentally as well. How have the sales held up over the first quarter? We'll also look at the different operating units. They obviously have that e-commerce business, but AWS not growing as fast as Google or Microsoft, but certainly still pumping out a lot of profit. We'll look at the different units. There was concerns about advertising services, third-party sellers. Not a huge impact yet on tariffs. I listened to the conference call. We'll discuss that. We'll look at the balance sheet and then we'll look at cash flows. How much did the company spend on their data centers and CapEx in the most recent quarter? How does that look for the rest of the year? When we looked at Google, when we looked at Microsoft, they weren't quite spending as much, meaning back half of the year is going to be big. Amazon already on that $100 billion run rate. And then, like I said, we'll also talk about this one technically, butting up against resistance right at 190, pulling back. We've got a green box. We've got a buying zone with Amazon. Now, speaking of buying zones, we got Equity Empire. We've been issuing them as much as we possibly can. And I tell you what, things have been looking pretty good. We've got earnings videos. Those of you that have already taken advantage of our early bird offer, thank you very much. Links down in the description below for that. Now, over the past year with Amazon, shares are up only 6%, but year to date down 13%, creating an opportunity for anybody that is looking out in the future with Amazon. Revenue in the most recent quarter, $155.7 billion. That was 9% growth year over year, beat expectations, but it's all about that guidance, and they're trying to thread the needle over at Amazon. They obviously don't know the full impact of these tariffs. Some are on, some have been taking off. The China sellers may be pulling back, maybe raising prices. Nobody really knows for sure yet. This uncertainty creating an opportunity. Revenue in the upcoming quarter, the second quarter, $159 billion up to $164. The company said on the conference call that they actually haven't seen a lot of impact of sellers raising prices and those types of things, because obviously it's still a very fluid situation as it relates to tariff. There was also a lot of pre-buying of inventory. When we start talking about the segment results, they said that North America and international, the operating profit actually would have been higher if it wasn't for the company pre-buying inventory. So my guess is most sellers, including Amazon, they talked about their third-party sellers also pre-buying inventory in anticipation of the hike in tariffs. So it's possible that Amazon is sitting on a higher level of inventory. We'll dissect that more when we get to the balance sheet, but the third-party sellers as well might not actually be impacted by the tariffs for a little while. Now, the Q2 guidance on Wall Street called for about $161 billion of revenue. The high end was for 164. The low end, these people might be smoking some of this stuff that they're smoking in this hotel room. 156 on the low end. Amazon guided between 159 and 164. Like I said, the consensus on Wall Street was a shade over 161. In terms of operating income, $13 billion to $17.5 billion, a wide range there. Last year, the company printed $14.7 billion to the operating side. Now, what did they do in the most recent quarter? $155 billion in revenue. Talked a lot on the conference call about fulfillment, how they're making some changes there, continuing to reinvest there. Obviously, robotics becomes a big story as we move into later this year into next year. $22 billion up to 24.6. Seems like a modest increase considering your sales increased as well. What they didn't spend more on was sales and marketing. Look, year over year on sales and marketing, $9.66 billion up to just $9.76 billion. G&A costs actually declined, so your total operating expenses at Amazon, $128 billion up to $137.2 billion. So your operating income year over year, 15.3 up to $18.45 billion. I would stop at operating income on Amazon. That is why some of the traditional valuation metrics that rely on things like net income don't always apply very well. That is because the company has this beautiful other operating income of nearly $2.75 billion related to its Anthropic investment. You also have interest income coming in as well. Operating income, $18 billion. It's about as good as it gets, especially for a quarter that laps a holiday shopping season. So the upcoming quarter, I tell you what, if you can come in at $17.5 billion, in a non-holiday shopping season. It's probably absolutely fantastic. Now, North American e-commerce business is finally profitable. No longer is the case that this company doesn't make money selling goods. It does. In fact, $5.8 billion of operating income in North America. Like I said, that operating income actually would have been higher if it wasn't for the pre-buying of inventory in anticipation of those tariffs. That pre-buying could pay off later in the year, especially if those tariffs stay in place and other retailers have to jack up prices. You also have competition from Temu and the other China direct e-commerce sites. Those sites probably more negatively impacted than even Amazon will. In the international business, you made $1 billion, not a million, $1 billion. And on AWS of $29.3 billion in revenue. Again, slightly lower growth rate. We saw north of 30% growth rate at Microsoft, which was unbelievable. I believe Google was in the high 20s. Amazon growing at a much higher revenue clip. So the dollar figure, though, over $4 billion. Operating income, $11.6 billion. Online stores grew 5% year over year. Physical stores growing at 6%, which is very much consistent with what you've seen over the past year or so. Third-party sellers growing at just 6%. This is a problem for the company. You have seen a deceleration here as they've jacked up fees. You also have a lot of Chinese sellers on the site that basically make it tough. If you're not selling direct from the manufacturer in China, it's tough to compete there. So third-party sellers have actually been fleeing the platform. Again, unless you're one of these Chinese-based sellers. So it'll be interesting to see how this company navigates that going forward. Advertising is driven in a large part because of third-party sellers. You notice that third-party sellers, the sales growth rate has been declining, and so has your advertising services. Advertising, this $13.9 billion, highly profitable for the company. And so they need to figure out a way to keep these third-party sellers happy, reinvigorate the sales, and potentially reaccelerate those advertising growth. Subscription services, which includes your Prime services, very steady at 11% growth rate. AWS growing at 17%, somewhat lighter than the previous quarters, which you were growing closer to 19%. From a balance sheet perspective, you got a boatload of cash over at this company, offset by some long-term debt. But when you come over here to cash flows, shows you a company that is wildly profitable, and they have operating cash flow in the most recent quarter at $17 billion. You have higher depreciation. That is because as you invest in CapEx, that depreciation shows up on the cash flow statement in higher amounts. Last year on the CapEx, property, plant, and equipment, $15 billion. Boom, all the way up to $25 billion. I believe the company is projecting $100 billion for the upcoming year. Last year, they spent $93 billion, or rather that $93 billion is actually a trailing 12-month number. Now, come down to other investments. Company is not doing massive buybacks, paying dividends like other tech stocks. They continue to reinvest it in the business, and considering the growth rate and the track record, probably a good thing. Now, the company got rejected at this 190 per share. 190 was resistance all through the 2020, 2021 era, 2024. Once you broke above it, you had kind of the momentum trade carry you back into the 240s. You did a full back test to 190, then you broke through it, and now here you are hovering in that range. I have a buy zone between 148 and 188 on this one. It also butts up against this yellow line, which is more or less the longer term trend, which has been intact for over 20 years. So here you are with Amazon. Anytime you're approaching the longer term trend, anytime you're in this 189 range, it is a buying opportunity for those of you that want to step in. Understand that when you buy on trend, when you buy underneath resistance, things aren't always rosy. And with the tariffs and the Chinese situation and the third-party seller situation, certainly has some uncertainty. And as that uncertainty becomes certainty or becomes clear, shares of Amazon will likely move higher. That was Amazon's Q1 results. Again, head on over to Equity Empire if you want more earnings videos and my recommendations on stocks. Thank you everybody that has already subscribed. Look forward to see you guys over there very soon. Good luck with your investments.